Hey everyone. Commercial real estate sales volume surged last year, climbing about 35% from the pre-pandemic levels of 2019 to mark the most active year on record. Part of that was driven by cross-border investment activity, with the fourth quarter of last year delivering the second strongest quarter on record of direct foreign investment in U.S. real estate. In this video, I'll share some insights into foreign investments in U.S. commercial real estate, who's buying, what they're buying, and where they're buying. To start, I want to highlight what we can track and what we can't. We can measure direct foreign investment, where a person or a company in another country directly invests into commercial real estate. However, we cannot track indirect foreign investment, where an international capital source puts money into a U.S. fund or goes through another intermediary to buy real estate. So for this video, I will focus on direct foreign investment only. As I mentioned at the start of this video, foreign investment in the fourth quarter of last year was one of the strongest on record, about $33 billion, second only to the fourth quarter of 2015, when about $39 billion was purchased by international money. On average, over the last 10 years, international investors buy about $60 billion of commercial real estate each year. Last year, the total was about $70 billion, and the most active year was in 2015, when about $100 billion was placed. Canada has been the #1 source of international investment into U.S. real estate in 9 of the last 10 years. The exception was in 2016, when China led the way with acquisitions, including a 15-property hotel portfolio for $5.5 billion. Canada investors comprise 32% of the foreign capital placed in U.S. commercial real estate over the last 10 years, followed by Singapore, then China, Germany, and South Korea. Still, foreign investment comprises just 10.3% of the total commercial real estate dollar volume on average, and last year it was below that at 9.1% of the total. In terms of where international investors buy, they tend to favor gateway markets, with New York, San Francisco, and LA leading the list. Investors more familiar with the US, like those from Canada, tend to be more willing to place capital into secondary and even tertiary markets. The most active property types for international investors last year were industrial and apartments, which comprised about 2/3 of the activity. Traditionally, office has been the most active segment, led by trophy office building trades. Between 2010 and 2014, office properties constituted about 50% of the total investment dollar volume. But the trends do change over time. In 2016, hotels climbed to the second place on the list, and in 2018, retail garnered the most dollar volume. When it comes to deal size, generally foreign investors need to place large volumes of capital. As a result, they often favor portfolios and very large assets. The average single asset deal size last year was $36 million. Another consideration is that foreign investors are often driven by different motivations than their U.S. counterparts. Sometimes they focus on yield, like their domestic competition, but remember that their cost of capital and the native yields they're used to may be quite different than in the U.S. So while a 3 cap may be really pushing it for a U.S. investor, some Canadian or European investors may consider that kind of yield relatively normal. In other instances, foreign investors may be more focused on the preservation of capital. That means they may be willing to pay a higher price than their competition just to put their money into a safe place. At the end of the day, international capital comprises a relatively small segment of the market, and the key factors driving their decisions can be very different from U.S. investors. If an owner is selling a property in the sweet spot for this business segment, access to foreign investors, especially from Canada, can be important, but it shouldn't be the only consideration. As always, investors need to consider the broader market, the big picture, and keep their eyes on the horizon.